How's it going, everybody? This is Beat the Bush. Today, I'm going to look at the S&P 500 and if you can really count on it to give you 10% annual returns every single year. This video is brought to you by Webull. You can get 2 free shares of stock valued at up to $2,000, 1 share for opening up an account and 1 share for depositing just $5. Check out my referral link down in the video description below. Now, you've been watching this channel, you realize that I try to time the market quite often. Sometimes I buy individual stocks, sometimes I buy very, very volatile crypto. I don't know what it is about me. There's not really a gambling gene because I don't actually like gambling at a casino. I'd say in the very, very beginning when I started investing, I just kind of listened to all the advice. Okay, you just pick a 401k plan, you pick some sort of target date fund, and I just left it in there. And once in a while, after I see the market drops a lot and I get scared and stuff, I just pull it out, right? And of course, I didn't make very good gains on those years, but also it didn't matter too much because I had very little money in it. But now that I am sort of semi-retired and I played around with stocks enough to know that, well, I'm kind of lagging behind. If I took all the lucky hits that I got, right? Bitcoin having made me maybe 30K, Tesla made me about 60K, Dogecoin made me about 120, 130K or so far. If you add all this up and add up, some of the good gains that I've had in other things, I probably lag behind if I just invested in the S&P 500 all the way from the very beginning and just kept on dollar cost averaging and just kept on piling more and more money in as I got more. I probably would have been quite a bit better off than right now. But the thing that keeps me from going all in it right now or ever is usually because I have this timing the market mentality where I think that, oh, it's at all-time highs. Maybe I can wait maybe a couple years because it looks like it's really high and it's going to drop down by, let's say, 40%, 50%. It's going to have another dramatic event like the dot-com bust or maybe the housing bubble bust, right? All of those events cause dramatic downturns, and then I can swoop in and pick some up and then, get like 50% gain within 1 year or so. All-time highs. It's as high as it's ever going to be. It's not going to go higher than that. But if you really look at the S&P 500, right, it just keeps on going up. You cannot count on it always going up, right? But the thing is, if you can wait long-term, 3 years, 5 years, 10 years, or maybe 20 years, 30 years, then you have a very, very high probability that you will make better than average gains of an average investor. Take a look at 2008. That 1 year decline is about minus 38%, and around the dot-com bust, it was minus 10% 1 year, minus 13%, and then minus 23%. They can get you really scared looking at those things, and if you just happen to buy it and it does that, then what you're supposed to do is wait it out. Even if it takes 3 years, you need to wait it out. Usually it comes back within 1.5 years. So you need this mentality that if it drops that much, you have to wait that long for it to come back. Here's the S&P 500 annual returns from 1928 to 2021. In total, 94 data points over here. And you can see, it goes up and down. There's a lot of up, but it's really hard to make anything out of it. So I decided to take a look at it, what happens statistically if you're able to have a longer time frame. Let's say you are able to hold on for 3 years, 5 years, and 10 years. This is what happens when you hold on to it for 3 years. How I did the calculation is I took a look at what happens at the beginning of the year and beginning of the year 3 years later, and then you took a look at the returns there. And the number that you see here is compounded annual growth rate. Let's say it's 30% and you just divide by 3. It's not that. If it's a 10% compounded annual growth rate, and you do this for 3 years, it's gonna be 10% the first year. And if you do another 10% the next year, you're actually gonna get 11%. So this is a compounded number that you see here. So if I just do a 3-year period and you randomly pick the history anywhere on the history of the S&P 500. This is the histogram over here of 91 points. So it has a good, good amount of points. And you can just kind of eyeball that most of the data points here is above 0%. But there are a few that are not so good. There are 3 data points that are minus 12%. There are 5 data points that are at minus 10%. 2 data points at minus 8, 2 at minus 6, 2 at minus 4, and 2 at minus 2. Statistically, there is a lot of chances that you will get more than 0% gain. On average, you're actually gonna get probably around 7% gain if you average all this out together. So you can kind of think of it like this. You start investing, you don't know when it's gonna go up or down. You have to assume you don't know because you really don't. Otherwise, you can just keep on timing the market and get like really, really outsized gains. So I'm gonna sit here in a position and say, I don't know where the market is gonna go tomorrow or the next year, but statistically, if I start investing in it, let's just say it's like a random dart to this histogram chart, and any single data point has an equal chance of success. On average, you can see that I have a high chance of having positive gains over 3 years. In fact, let's say I get to repeat this over and over again. I get to keep on throwing darts at it. This is actually a really positive sum game because if I just keep on throwing darts at it, sometimes I might get minus 12% over a 3-year period. Sometimes I might get positive 28%. But if I keep on doing this, I'm going to make money. Now, I'm making this video partly to convince you guys and also to convince myself. Yes, I miss out on the run up on the S&P 500. But you know, you got to get in sometime. It's all at all-time highs right now. Either I get it now or never, basically. So I put in some of it in and I have a little bit cash left over. I'd say probably about 25% of my portfolio is still in cash, and I'll probably wait a little bit and then I'll put the rest in, just to let you guys know that I'm not just kind of talking over this, because you know that I invested in individual stocks. In fact, I just sold one portion of my individual stocks in Coinbase. I realized that I didn't do much research into it, so I just sold that off and used the money to buy into the S&P 500. In particular, I just bought VOO. I didn't really go for the zero management fee thing. Here's the 5-year histogram. I have 89 points here, and you can see the extremes kind of shrunk in. Before, it was minus 12 to 28%. Now, it's minus 12 and then 24% if you do a 5-year period. But you can see that the certainty of getting 10% gains get more and more prominent. The main peak here is actually at around 8%. Yeah, if you hold for a really long period, at least over the entire history of the S&P 500 all the way to 1924, you're gonna be able to expect about 8% gain. But if you kind of look more recently in the past 3 decades, then the gains are actually higher. Why is that? I am not too sure. Maybe, you know, growth is sort of more exponential now. Maybe we have more technology. So now let's take a look at the 10-year, because I think 10-year is probably doable for me. If I am 40, if I'm willing to wait it out all the way till I'm 50, this is what I can expect. 10-year period histogram. This is compounded annual growth rates. Over this 10-year period, if you just kind of eyeball it, it's also around 7%. The extremes really, really flattens out. The most negative that you'll ever get over a 10-year period is minus 5%. Well, this is kind of worth it because there's only 3 chances out of 84 that you're going to get a minus 5, but there's like a whole bunch of chances that you're going to get a positive gain. Look, there's 3 chances that you're going to get 16% gain. Compounded, this is huge. There's 10 chances that you're going to get 11% compounded annual gain, 12%. 10 chances that you're also going to get compounded annual gain. So if you just throw a dart at this, these are really, really good odds if you want to kind of have high certainty that you're going to make good gains. If you look at all the retirement YouTube channels, this is like the advice they spew out. But I really want to take away all the doubts over here, because somehow when I invested, I knew all of this already. I know about, you know, long-term dollar cost averaging, S&P 500. I know all the things I talk about in this video. But I think the main thing that kept me from piling all my money in, maybe even 3 years ago when I, you know, kind of really went full-time on YouTube, is I still have in the back of my mind that I feel like I can outperform the market. And my gosh, it really took my whole investing career, like what, 15 years or so, all the way since I'm 25, to realize that, oh my gosh, you know, I tried all I can. I tried very, very short-term investing, day trading for an entire year. I tried somewhat longer-ish type of trading. I tried buying this or that. Yeah, I have some successes over here, but I'm starting to realize that I am trailing behind in the gains. And luckily, I don't have that much assets all along the way. So now that I, amassed enough fortune, it is that much critical to get it right over the long period. So if you really, really believe this, you can have pretty high certainty that even if you invest today, at all-time highs, you have over 94% chance that you are going to make more money than before. You're not always going to make like 20% gain every year, but you have probably over 50% chance that you're going to make compounded annual gains of over 8%. And this is a really, really good odd. Thanks for watching this video. I hope this kind of helps you guys out in doing what I personally am afraid of doing. And I personally am not 100% into S&P 500 yet. I'd say maybe, half of it is in there right now. And I'm sort of dollar cost averaging into it because I am a little afraid that it might drop significantly. There's always a lot of news out there. Delta variant, Lambda variant, right? That might just tank the economy. The thing you are investing in when you invest really long term, you have to believe that the US economy, the US ingenuity is going to keep on going up. Whatever production rate that we're at in all the companies, right? People always figure out how to make something faster and cheaper because of capitalism, right? Quality of life has gone up historically. It has trickled up higher and higher. And I think this is kind of what you're investing in when you invest in S&P 500 long term. Timing the market is kind of like being stubborn or like, thinking that you're special because, you got to think you're special a little bit because, you gotta try, or else you don't know if you're like some super genius investor. You like buy this and it goes up, you buy that, it goes up, and then oh my gosh, you can get like 30% gain, 50% gain every year, year after year, right? Very few people do that. Thanks for watching this video. Don't forget to get your 2 free shares at Webull as long as you open up an account and get 1 share. Deposit $5, get a second share. Like this video and subscribe for more. Thanks for watching.